An ongoing battle between central banks and markets has intensified in recent weeks. The debate, whether inflationary pressures are persistent or transitory. Robust demand for goods, global supply chain disruptions, and rising energy prices have contributed to price pressures. Central banks have largely held the view that these pressures are mostly temporary, but investors are becoming increasingly worried that these pressures will be more enduring. And, as a result, there are growing concerns that central banks may need to hike interest rates sooner than previously expected. Accordingly, we have seen sharp increases in Australian bond and swap rates in the past couple of weeks. And markets had brought forward their expectations for the first RBA rate hike to the second half of next year. On Wednesday, the inflation report for the September quarter was released. The key point of focus, a hotter than expected reading on a key metric that feeds into the RBA's monetary policy decisions. That is, underlying inflation, as measured by the trimmed mean. It rose 0.7% in the quarter, while markets were expecting a 0.5% rise. That might not sound like a big difference, but it added fuel to the fire and markets jumped. The 3-year bond yield climbed sharply and rate hike expectations were brought forward even further to the middle of next year. In annual terms, trimmed mean inflation increased by 2.1%. This marks the first time underlying inflation was within the RBA's 2 to 3% target band since 2015. In its most recent forecast from August, the RBA did not expect underlying inflation to reach these levels until 2023. Markets are correct to contest the RBA's stance that the cash rate won't increase until 2024. But with cash rate liftoff priced in for mid-next year, we believe there is a risk financial markets have gone too far in the other direction. We continue to expect that underlying inflation will approach the upper half of the target band by the end of next year, in turn spurring the first cash rate hike in 2023. It will depend critically on how quickly the economy rebounds and in particular how fast wages growth picks up.